Hello everyone. So the second topic for Module 1 is understanding the bank's financial statements. So just a quick recap of the basic accounting equation. I suppose everyone is familiar since basic accounting is a subject in your senior high school. So basic accounting equation, we have assets equals liabilities plus stockholders' equity. So when you say assets, it's the economic resources owned by a business, composed of the current assets and non-current assets. The liabilities are the financial obligations or debts of a business. And stockholders' equity is the owner's claims on the assets of the business, or basically its capital. So I want to share a banking trivia with all of you. So did you know that the more money savers or individuals like you put in the bank means the more liabilities or obligations the bank has? Why? So it is because depositing your money in the bank means you are lending your funds to the bank. Your funds are then used to finance the client's need for loans or for other users of credit. In other words, the more you save and deposit, the more debts the bank has. The bank must be liquid enough to sustain your withdrawals the moment you need your money back. We all know that banks are known for providing funds or money in the form of loans to those people or firms that are in need of it. But, in a different perspective though, remember that depositors or savers like you are also the lenders, while the bank is the borrower. So I hope the concept is clear. I want to show a comparison between a non-bank and banking firm's balance sheet. So as you could see, a typical non-bank firm's statement of financial position is composed of its non-current assets, its working capital or current assets, net debt or net liabilities, and equity. On the other side, a typical bank's balance sheet is composed of loans. So why are loans considered as assets of the bank? Because loans are the lifeblood of banks. When banks lend money to borrowers, borrowers pay the bank in principal plus interest. Interest income is the primary income of banks. This will be explained in the next chapters. So at least please research in advance so you have an idea already. We also have trading assets and property or fixed assets. Its liabilities are the deposits. So why again deposits are considered debts in the banking perspective? I guess I already explained this on the previous slide. So that's it. And we have also trading liabilities, debt, and equity. Sample financial statements. Balance sheet. A balance sheet is a financial report that shows the value of a firm's assets, liabilities, and owner's equity on a specific date, usually at the end of an accounting period such as a quarter or a year. So as shown in the illustration is BPI's statement of condition, and below are its asset accounts. So what is an asset? An asset is anything that can be sold for value or anything that the firm or the bank owns. Next is the liabilities and equity portion of the balance sheet. A bank uses liabilities to buy assets which earn its income. By using liabilities such as deposits or borrowings to finance assets such as loans to individuals or businesses, or to buy interest-earning securities, the owners of the bank can leverage their bank capital to earn much more than would otherwise be possible using only the bank's capital. Assets and liabilities are further distinguished as being either current or long-term. Current liabilities are expected to be paid within 1 year, or otherwise the liabilities are long-term or non-current liabilities. Working capital is the excess of current assets over current liabilities, a measure of its liquidity, meaning its ability to meet short-term debts. Next is the capital funds or bank capital. Banks can also get more funds either from the bank's owners or, if it is a corporation, by issuing more stocks. Capital reserve or reserves is an account in the equity section of the balance sheet that can be used for contingencies or to offset capital losses. It is derived from the accumulated capital surplus of a company created out of capital profit. Reserves are usually money earmarked by the company for specific purposes. Surplus, on the other hand, is another type of account under the equity portion where all the profits of the company reside. Income statement. Again, the overall structure of an income statement for a bank doesn't stray too far from a regular income statement. The top of the income statement is revenue or income, and the bottom is net income. However, revenue is derived differently from that of regular companies. The income statement will generally look as follows. Balance sheet accounts. So to supplement this presentation I prepared for you, please refer to the reference material I gave and study chapter 2. First asset account on the balance sheet of banks is the COH or cash on hand. It is the total amount of cash in the bank's vault in the form of notes and coins under the custody of the cash custodian. It could be in local or foreign currency. What is a bank vault? A bank vault is a secure space where money, valuables, records, and documents are stored. It is intended to protect their contents from theft, unauthorized use, fire, natural disasters, and other threats. The second asset account are the checks and other cash items or COCI. It is the total amount of checks and other cash items received after the selected clearing cutoff until the close of the regular banking hours. Third, we have the asset account due from Bangko Sentral ng Pilipinas. It is the balance of the deposit account maintained by the bank with BSP. So we have two, local currency and foreign currency. Local currency is the amount due from BSP denominated in the Philippine currency to meet reserve requirements and to serve as clearing account for interbank claims. On the other hand, foreign currency is the amount due from BSP denominated in foreign currency. Next, we have the demand deposit. A demand deposit account consists of funds held in a bank account from which deposited funds can be withdrawn at any time, such as checking account. Second is overnight deposit. It is a deposit with a next day maturity. This instrument category comprises mainly those sight or demand deposits that are fully transferable by checks or similar instrument. It also includes non-transferable deposits that are convertible on demand or by close of business the following day. And lastly, term deposit or the very famous time deposit is a cash investment held at a financial institution. Your money is invested for an agreed rate of interest over a fixed amount of time or term. Term deposits can be invested into a bank, building society, or credit union. Next is due from other banks. Balances of deposit accounts maintained with other resident banks, excluding loans and advances or the resident banks. On the other hand, balances of deposit account maintained with non-resident banks and offshore banking units or non-resident banks. So what is an offshore banking? So an offshore banking unit is a bank shell branch located in another international financial center. For instance, a London-based bank with a branch located in New Delhi. Short-term instruments. These are interest-bearing short-term asset funds sold, excess reserves that one bank lent to another, securities purchased under agreement to resell or reverse repurchase agreements, and other bank certificates of deposit. Next, we have securities. Any eligible type of debt securities that a bank owns may be at any maturity and valued at market value or at what the bank paid for, plus or minus an amortized adjustment towards the maturity value of the principal. Securities must be classified as either HTM or hold to maturity, available for sale, or trading securities. Trading account assets. Any of the preceding securities or other marketable assets that are held primarily for resale within relatively short periods, with the intent of profiting from short-term price movements. Loans and receivables. Loans are the primary earning asset of most banks. Banks lend funds to borrowers and in return, promissory notes get interest whether at a fixed or variable rate and repay the principal. The borrower agrees to a certain set of terms including any finance charges, interest, repayment date, and other conditions. In some cases, the lender may require collateral to secure the loan and ensure repayment. So here are examples of loans and receivables. We have developmental loans, commercial loans, consumer loans, and real estate loans. Next, we have leases. It consists of outstanding balances on leases of assets owned directly or indirectly by the bank. Bank premises, furniture, fixture, and equipment. This is also known as the PPE in accounting, so it refers to real and other properties and facilities used or to be used for banking purposes. Investment property. So these are real estate property or facilities acquired with the intention of earning a return on investment either through rental income, the future resale of the property, or both. Equity investment in subsidiaries, associates, and joint ventures. It's the amount of the bank's investments in the equity instruments of unconsolidated subsidiaries, associates, and joint ventures. Deferral. What is a deferral? A deferral in accrual accounting is any account where the asset or liability is not realized until a future date. Example, annuities, charges, taxes, income, and etc. The deferred item may be carried, dependent on type of deferral, as either an asset or liability. So here we have deferred tax asset. It's the amount of income taxes that can be recovered in future periods in respect of deductible temporary differences, carry forward of unused tax losses, and carry forward of unused tax credits. Intangible assets. Identifiable non-monetary asset without physical substance. Examples are patents, copyrights, and goodwill. And lastly, we have other assets, a catch-all category of other assets not large enough to warrant a separate account. So we go now to the liability accounts. First, we have deposit liabilities. Demand deposits. Deposits subject to withdrawal by check through available bank channels like over-the-counter in the bank or automated tellering machines or ATMs. Savings deposits, just the same as the demand deposits, are deposits which are withdrawable upon demand through available bank channels. Negotiable order of withdrawal. These are interest-bearing savings deposit which are withdrawable by means of negotiable order of withdrawal or NOW accounts. NOW accounts are checking accounts that pay interest. Sometimes, banks require you to keep a certain minimum amount of money, a minimum balance, in your NOW account in order to keep earning interest. Only non-business customers may open NOW accounts, and businesses must use regular checking accounts. Time certificates of deposit. These are interest-bearing deposits with specific maturity dates and evidenced by certificates issued by the bank. Long-term negotiable certificates of deposit. These are interest-bearing negotiable certificates of deposit with a minimum maturity of 5 years. Due to other banks. Due to resident banks are credit balances of accounts maintained by other resident banks. Due to non-resident banks, on the other hand, are credit balances of deposit accounts maintained by non-resident banks denominated in local currency. So note, the due to account is also called an account payable. Due to Bangko Sentral ng Pilipinas. Supervision fee, it's the estimated liability for the bank's share in the cost of maintaining the appropriate supervision and examination department of BSP. So, others, items or transactions which cannot be appropriately classified under any of the foregoing due to BSP accounts. Bills payable. These are amortized costs of obligations to the BSP, interbank loans payable, other deposit substitute, and other bills payable. Bonds payable are amortized costs of obligations arising from the issuance of bonds. And lastly, other liabilities. These are catch-all category for the remaining liabilities. This includes accrued taxes and expenses, dividends payable, trade payable, and other miscellaneous liabilities. Equity account. Paid-in capital stock, we have two, common stock and preferred stock. I suppose this is familiar to all of you because this is in your basic accounting. So common stock, total par or stated value of all the bank's outstanding shares. And preferred stock pays a fixed or variable dividend that is not a tax-deductible expense. Income statement. An income statement or profit and loss account is one of the financial statements of a company that shows the company's revenues and expenses during a particular period of time. It indicates how the revenues are transformed into the net income or net profit. Income statement accounts. Just a recap, loans are again the primary earning asset of banks. Why? Because on top of the principal that is paid, the bank earns interest. This makes interest the primary source of income for banks. So here we have interest income. Interest the bank receives on each of its specific asset categories, namely loans, securities, and short-term instruments. Interest expense. Payments and/or monthly accruals of interest on financial liabilities. So to review, when you as individuals deposit your money to the bank, you are expecting interest from it. On the bank's perspective, it spends for the interest of your funds lent to them or deposited to them. That is again an interest expense. So in a typical income statement, interest income is the gross revenues or sales, while interest expense is the COGS or the cost of goods sold. So the difference of the two is what we call gross income or gross profit. Provision for credit losses on loans and receivables and other financial assets. It is the impairment loss on loans and receivables and other financial assets which will be debited to set up the allowance for losses on the said financial assets. It is also called the allowance for bad debts in basic accounting. Other income. It includes income from maintenance fees and various activity fees that banks charge on their deposit accounts. It also includes income from the bank's trust department, commissions on insurance premiums, income from direct lease financing, and the likes. Other expenses. General category for banks' non-interest operating expenses, for example, advertisings and promotions. Provision for income tax. Monthly provision for income tax. Lastly, we have net income or net profit, net earnings or the bottom line, the amount a bank earns after subtracting taxes and other deductions from gross income. So basically, why do businesses and banks exist? Because of profit or income. Introduction to loan loss accounting. So for the figures shown in this slide, please refer to the tables on chapter 2 of the reference material I gave and please study. So that's the end of our second topic. Again, please study chapter 2 of the reference material I gave and thank you.